Welcome to another night of Facebook Live with Realty One. Again, here I am, Tim Gupton, and we've got an old friend of mine, Jimmy Eggers, here from Smith Leonard Accountants, and he's going to talk to us tonight a little bit about the new tax bill, how home ownership is affected by taxes, and Jimmy and I have known each other since before high school, I think.
Yeah, slugged it out on the soccer field.
Yeah. So smart guy, and Jimmy, why don't you just tell us a little bit about yourself and your company, and then we'll get kind of into the questions.
Cool, thanks. So like Tim said, I work for Smith Leonard. It's a public accounting firm, regionally based. We've got 3 offices in the Triad here. My focus is over on the tax side. Smith Leonard's kind of traditional big-ish audit tax type firm. Mm-hmm. I focus on the flow-through area, the family wealth, asset protection, and individual taxation area. And so I've been back with the firm for 2 years and was there for 8 years before I switched jobs and tried my hand in wealth management for a little bit. So
okay.
But anyway, like he said, hopefully I can answer some questions and maybe slow some hyperbole that the media has been spewing out there, and
sure,
shed some truth on things.
So. A lot of our viewers, probably most of them are homeowners, or if they're not homeowners, maybe hopefully they're considering buying a home. And like you said, there's probably some rumors and stuff going around about the new tax bill.
Yeah.
And so why don't you just start by maybe talking a little bit about what we talked about earlier, and just how do you think it's going to affect the homeowner in general?
I think so. There's several different things. Tim and I were talking earlier. We've got some interest rate hikes on the horizon. We've got this tax bill that's come through. It's going to be interesting to see, but I would say overall it should still be a net positive in the real estate market. I think inventory levels, as we discussed, have been low. There's some business incentives going on the side that I think will start to flush the market with a little bit more supply. Mm-hmm. So I think from that standpoint, we'll keep fairly stationary. As far as the homeowner, the kind of benefits they might gain, lose, whatever, that they're raising the standard deduction up, basically doubling it. Take it from 12 to 24. They're eliminating some state and local tax deductions, capping those at $10,000 a year. But I still think at the end of the day, I think home ownership is still going to be the right way to go. I still think there's going to be tax benefits there. Mortgage interest, they're not, other than some of the caps on the amount of debt you can have, they're not really doing anything there. They're still allowing the full deductibility.
Talk to me a little bit about what we talked about earlier with the home equity line. I know a lot of people, there's some confusion about that. Can you just kind of go over a little bit about the basis of that?
Yeah. So back pre-2018, you were able to deduct interest on up to $1 million of acquisition indebtedness and up to $100,000 of home equity indebtedness. And kind of the way that worked is acquisition indebtedness is quote unquote money used for the construction, the rehabilitation, or the acquisition of a piece of property. Home equity line debt pre-2018, if you didn't exceed the $1 million of acquisition debt and you used your home equity line to expand your house, build upon your house, that actually became acquisition in debt and was not home equity debt. Mm-hmm. Home equity debt kicks in once you reach that $1 million threshold for the acquisition debt. And then further, if you use it to go buy, a business or a Ferrari or a Mercedes-Benz or whatever the case may be, you're using it for improvement purposes, if you will.
Sure.
So with the new law, that home equity line debt, the deductibility of the interest on the home equity line debt goes away. But still, if you're up under the $750,000 threshold and that money's used to substantially improve, it's still acquisition debt and will be clean debt for purposes of the interest deduction. Hopefully that helps.
Yeah, I think that clears up a lot. I know there were a lot of questions out there about the equity. So having that cleared up and talking about the benefits of home ownership, just give me your we talked a little bit about maybe some builders out there or some of the business benefits as far as residential construction or business.
So as part of the law, in my opinion, the big aspects, the big movers, needle movers of the law were general business, C corporation, and flow through business. And by that I mean, starting with the C Corp, we have this massive reduction in tax rate. We go from 35% to 21%. That's obviously trying to get some of those jobs from overseas back over here. I applaud the effort. Hopefully it works.
Sure.
But as far as, real estate by and large is operated out of flow-through entities. The way I see it is investment is typically LLCs or partnerships. Brokerage, like you guys do here, could be anything. It could be an LLC or it could be an S Corp. Development and construction are usually done in LLCs or S Corps. Sure. And so what the government's done is for those types of entities, they allow for up to a 20% pass-through income deduction. Okay. And so I think what you're going to see, Tim, that coupled with, because these are flow-through entities, all the income's taxed to the owner, right, at the individual level. So we've got this 20% business income cut or deduction, and then we've got this tax rate cut from 39.6 to 37%. When you add it all up, it kind of caps the top marginal tax rate for those types of entities at 29.6%, which is a 10% tax cut, right?
Sure.
So I could see that potentially being big for folks who are over-levered. I could see them deleveraging, but to your point, some of the builders and the developers, we've already seen a kind of a flurry of activity. I think you're going to see that grow a little bit. Which will contribute, I think, to rising inventory levels, which I think is what you want to see, and you want to see that demand. You want to see that demand from these so-called taxpayers, if you will, to buy some houses and
I think that's what we've seen over the past, even this past year, 2017, is an increase in the builders, an increase in the development. So hopefully that continues and stimulates the inventory. So what is probably the most common tax saving strategy that people miss? Throw you a curveball?
Well, no.
Or is there a common one? I don't know. Maybe top three or something.
Well, I think that a big one that kind of feeds into kind of financial planning and retirement planning, one that I see amongst colleagues and even folks I work with, is just a retirement deduction, a 401k contribution, a SEP IRA contribution if you have a self-employed entity.
Sure.
I think that's a popular one. I think some other popular ones is it's weird, over the last 5 or 6 years we've had more and more people kind of breaking out of the W-2 mold and into that 1099 self-employed mode. And so I think some people are missing opportunities to deduct home office deductions, to convert what would ordinarily be personal expenses into those business deductions and get, pardon the expression, but some federal subsidization, right? I think those are oftentimes some big deductions that people miss. Those are kind of more the common ones I see. Taking advantage of those. The problem is, for a long time now, in fact, since George Bush had this radical change to the tax rates, is AMT, alternative minimum tax, has grabbed a lot of, I think, what you call upper middle to upper income taxpayers. And so what we've seen over my last 15, 16 years is the stripping of some of these deductions that people were afforded and got used to. And AMT has turned into the next 4-letter word, so to speak, right? So that's kind of, from my angle, that's kept us from taking advantage of certain things because we just get trapped, right? So that's kind of been my experience over, say, the last 15 or 16 years.
Okay, all right. Well, I mean, I think you've answered a lot of my questions. Is there anything else that you want to share with the real estate audience out there?
Yeah, I don't know. So we were studying these bills as they were coming through, right? I read all of the House version, all of the Senate version. And I'm not going to say something radically different came out, but something eye-opening different came out. And so the original bills contained really no tax breaks for the real estate industry. But lo and behold, when we came out at the other side, real estate investment all of a sudden got some favorable tax treatment here. And so initially what they were going to do with this 20% deduction is they were going to limit it to whether these businesses paid W-2 wages or not, right? But at the last minute, they had another aspect in it and said, okay, never mind, if you don't pay W-2 wages, we'll still give you a 20% business income deduction to the extent of 2.5% of your CapEx or your real estate costs, right? So you and I go and buy a $2 million piece of property and rent, make $400,000. We're limited. We could take 20%, 80 grand, up to 2.5% of that $2 million. So we could still take $50,000 deduction between us. And that was a very big aspect to this, in my opinion. So for those in the audience that like to invest, that are into the middle market investing rental, I think there's still great tax opportunities here too. It kind of leverages your money a little bit better for you.
Sure.
A little bit more money to maybe expand and buy some more properties along the way and just kind of add to that portfolio.
Fantastic. Well, that's all we have tonight. Again, I want to thank Jimmy Eggers for coming out and just talking to us a little bit about it. I think you can tell that Jimmy really knows his stuff. And of course, if you guys have questions for Jimmy or for me, just get in touch with me, message me on Facebook, and I'll be happy to give you Jimmy's contact information. Put you in touch with him, and he can help you with all your tax needs. So, thanks again for watching tonight, guys. Thank you, sir.
Thank you, Tim.
Appreciate it.
It was great.